Markets are trading in what increasingly feels like a theater of the absurd, where headlines shift faster than we can process them. Within hours yesterday, escalation threats from the US turned into ceasefire hopes, sending oil prices plunging and equity markets surging, only for reality to creep back in just as quickly. So oil and yields are up again this morning. Equities are pressured. The PMI numbers will give a first hint on how economic activity around the world reacted to Iranian war and the consequences. In the markets though, investors appear more stressed right now about missing the next rally than misreading the rest of the moment. But in a market driven by war headlines rather than fundamentals, that optimism may prove quite fragile. So welcome to Swissquote's daily market talk. It is Tuesday, 24th of March. I'm İpek Özkardeskaya, and everything I will say here today is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So it's one of these moments again where I don't have time to finish my sentence that new headlines are moving the markets upside down. Yesterday, when I returned to my desk on Monday morning, US President Donald Trump had given an ultimatum to Iran for 48 hours to open the Strait of Hormuz. A few hours were left before that deadline expired. And after expiration, he would obliterate the nation's power plants. Oil was up and the market sell-off was deep in Asia. Then by the time I posted my market talk and grabbed a coffee, well, Donald Trump had made a major U-turn, had just decided that he would give Iran 5 days of ceasefire following, I cite, very good and productive conversations regarding a complete and total resolution of our hostilities, he said, in the Middle East. This is exactly what he posted on Truth Social in capital letters. And markets were happy. US crude tanked 10%, Brent fell nearly 9%, yields fell as well, and equity markets rebounded with joy as if the war in Iran was over and we could go back to peace times. Remember peace times? It's been a while. Fun fact, Iranians said just after that there had been no direct or indirect contact with Donald Trump. So yes, Donald Trump chickens out because the Iranian bite was probably too big to be swallowed, but him chickening out won't calm the game in the Middle East if Iranians do not comply. This is why I was saying yesterday that Toko optimism is waning, or it should be waning, if you use common sense, because the whole concept of Donald Trump acting alone by himself and shaping the world alone doesn't work when the counterparty is not willing to play. The resolution in the Middle East is contingent on Iranians' willingness to stop the war as well. And in reality, the Strait of Hormuz remains closed with only few tankers crossing the critical water gate today, and oil rebounds this morning again, with both Brent and WTI up by more than 3% at the time I'm talking here. This morning, we are just before the European markets open and equities are pressured again. Asian equity indices are giving back early gains quite rapidly right now. Now, Donald Trump's 5-day ceasefire will end at the end of the trading week. Surprise! And what will happen next is anybody's guess. But yesterday's price action across global financial markets suggests that investors today are more scared and stressed to miss the post-war ride, one similar to the post-liberation day rebound in the global financial markets, than to make a few wrong starts. Investors will keep looking for any hint of optimism and jump on the occasion. But it's not always going to be the right call. Meanwhile, on the sidelines, policymakers around the world are watching through more critical and realistic lenses. European Central Bank officials, for example, warned that today's energy shock in Europe could turn into stagflation if energy prices remain high and highly volatile. In Japan, the recent data, show that inflation there fell to nearly a full-year low. That was good news, but the bad news was that the country's biggest labor group said that they secured an average pay rise of more than 5% for a third consecutive year, and 5% is well above the BOJ's inflation target and threatens to slow the work on bringing inflation down along with the rising energy prices. So the dollar yen eased yesterday to 158 level on the back of broadly softer US dollar, obviously on Donald Trump's unverified announcement regarding Iran, but the pair is up again this morning following a broad-based rebound that we see in the US dollar after investors just understood that Donald Trump can't ease tensions unilaterally. So market sentiment remains fully dependent on war headlines and energy prices. The market reactions are very extremely emotional right now. Everybody wants the war to end today, the latest sell-off to be a dip and to catch that dip. But uncertainties remain, obviously, and the taco trade and optimism can be sustainable if and only if Iran also decides to play along. And right now, that doesn't look like it's the case. And the newest headlines this morning suggest that Gulf countries are also considering joining the war. So nothing except the US president points at easing tensions right now. As a result, we keep waiting, we keep watching and following the headlines and watching the economic data in the meantime, because today we will have a first glimpse of how economic sectors around the world reacted to the Iranian war and the rising energy prices as a result of it, since the Middle East was put on fire at the start of this month, and the tightening monetary policy outlooks as a result of it. So March preliminary expectations mostly point lower, unsurprisingly, to a slower activity reflecting waning appetite and rising anxiety regarding the implications of another potential energy crisis that could prolong to we don't know when, and tighter central bank policies as a result of it, as I said. And in this context, Australia's manufacturing and services PMI, for example, both fell in March, with services slipping to the contraction zone below the 50 level and manufacturing PMI coming in very close to the 50 limit that separates contraction from expansion. Remember, the Reserve Bank of Australia also raises interest rates for the second time at last week's meeting. That was to counter the rising inflation expectations, inflationary pressures in Australia. Elsewhere, Japanese PMI figures fell too, pointing at slower expansion there in both services and manufacturing sectors. The Bank of Japan is still willing to normalize its policy to maintain price pressures in check, but the economic activity will be coming under pressure if the price pressures continue to push higher, and that regardless of how the Bank of Japan or other central banks will be reacting, because here we are talking about a supply shock that is much more difficult for a central bank to remedy with interest rate hikes. Back to numbers, while European PMI numbers are also expected to draw a similar conclusion, slowing activity on higher energy prices, rising inflation expectations, and potentially higher interest rates from the European Central Bank as well. As such, a set of soft and softer than expected PMI figures will hardly reverse the hawkish shift that we saw in central bank expectations since the start of the war in Iran. On the contrary, slowing activity combined with rising inflationary pressures around the world will fuel stagflation fears and could further weigh on investors' sentiment. Therefore, today, good news from PMI numbers will be good news, and bad news will be bad news for the markets. And moving forward, even if the war stopped here and today, it will take time to repair the damages caused to the Middle East energy infrastructure over the past month. Experts say that it will take months and even years in some cases to repair these damages and bring output back to pre-war levels. As such, an energy-led market stress would be harder to shrug off for global financial markets than a Trump-made trade crisis. This is when the TACO acronym had emerged, remember? By then, last April, Trump came with a bad surprise, huge tariffs, counterparts didn't have a say, they didn't have negotiating power, they just begged the US to reverse his decision, and Trump finally gave this grace to partners and lowered tariffs that were, after judge, illegal anyway. But that's very different from the war in Iran. The war in Iran looks much different and much harder to reverse than the trade tensions of last year. But that's just a cautious thinking, right? Nothing prevents investors around the world from buying like there's no tomorrow on every glimpse of hope out there, disregarding risks and pressured valuations on rising energy prices, rising operational costs, and squeezed margins. But this is all for today. Let's see what the headlines tell. This is all I can tell. I'm İpek Özkardeskaya, and thanks for joining me today, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow with new news and God knows what, but until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.